$92.56. That's where silver closed today, January 14th, 2026. But here's what caught my attention. In 1980, when silver hit its previous all-time high of $49, that represented the endpoint of a monetary crisis. When you adjust that $49 for inflation using official CPI data, it equals approximately $170 in today's dollars. We're at $92. That means even after a 150% surge in the past year, we're only halfway to where silver went during the last major currency crisis. And this time, the fundamentals are exponentially worse. Let me walk you through something that's been keeping me up at night. A pattern that's appeared in every fiat currency collapse in history. A pattern that's never failed. And right now, based on my analysis of publicly available data, we might be watching it complete in real time. I'm not a financial advisor. This isn't financial advice. This is purely educational analysis based on verifiable information. But by the end of this video, you'll understand exactly why some analysts believe we haven't even begun the real move yet. I've spent months studying historical monetary resets. They all follow a similar blueprint. 4 stages, always. And here's what concerns me most. Silver appears to be deep into stage 3 right now, with stage 4 potentially just beginning. Let me break down my thinking. Stage 1 is what I call the illusion of stability. Authorities create what looks like a functioning system. Prices get suppressed through paper markets. Everything seems fine. Everyone trusts the currency. For silver, this era began after 1980, when regulators, terrified by the Hunt brothers' near destruction of the COMEX, built something massive. A derivatives market that some analysts estimate is 50 to 100 times larger than the physical market. According to published COMEX data, open interest has historically represented multiples of available registered silver. Think about that. That means if even a fraction of paper holders demand actual delivery, the system faces serious stress. Stage 2 is about expansion and debasement. The gap between paper promises and physical reality expands. In my view, we've been living in stage 2 since 2008. Reports indicate global central banks printed over $30 trillion since the financial crisis. The US alone reportedly added trillions to its balance sheet. But here's the fascinating part. Silver didn't explode then. Why? My analysis suggests that every time physical demand increased, major banks reportedly flooded the market with paper contracts, short positions, derivatives. Prices stayed pinned below $30 for nearly a decade. Meanwhile, something critical was happening beneath the surface. Industrial demand transformed. Solar panels need silver coating for conductivity. Electric vehicles require roughly 3 times more silver than traditional cars. 5G infrastructure, AI data centers, medical devices, military applications. Industry reports now suggest industrial demand represents approximately 60% of total silver consumption, up from around 40% just a decade ago. And here's the part that really strikes me. Silver mine production hasn't kept pace. Data from mining reports show supply has declined since 2016. Analysts point to what they call a structural deficit, more silver consumed than mined for multiple consecutive years. So where's the difference coming from? Above-ground stockpiles, vaults, reserves, they're being systematically drained. Now this is where the pattern gets really interesting. Let me show you what happened the last time we saw this setup. 2 billionaire brothers, Nelson and William Hunt, looked at silver trading around $6 per ounce and saw something others missed. Inflation ravaging the dollar, consumption exceeding production, a perfect storm. So they accumulated approximately 200 million ounces, roughly 1/3 of America's entire silver supply at the time. Then January 1980 arrived. According to historical records, silver hit 49.45. That's roughly 724% in 18 months. Banks panicked. COMEX changed the rules overnight. They banned new long positions, forced liquidation only. Silver Thursday, March 27th, 1980. The crash came. The hunts were destroyed. But here's what matters most to me. The squeeze was real. The shortage was real. And that $49 price was real. It literally took changing the entire rulebook to stop it. Now adjust that $49 for inflation. Using the Bureau of Labor Statistics CPI calculator, $49 in January 1980 equals approximately $170 to $180 in today's dollars, depending on which month you calculate from. We're currently at $92. That's barely halfway. But consider this. The supply deficit appears worse now, industrial demand is higher now, and the paper market is exponentially larger now. Let me show you why this matters. In 2008, we saw a similar pattern with gold. Historical data shows gold was trading around $720 per ounce in October 2008. By September 2011, it reportedly hit 123, approximately a 167% surge. Why? In my view, when paper promises fail, when trust in fiat currencies erodes, money flows to physical reality, Gold, silver, real assets. And here's what concerns me about 208. The central banks didn't fix the underlying problem. They just made it bigger. Reports suggest they printed roughly $16 trillion globally, bought their own debt, suppressed interest rates to zero, expanded paper markets even further. Which brings us to today. Silver hit approximately $92 recently after a 150% surge in 1 year. That's the strongest annual performance in decades. But let's talk about what could happen next. Remember the Hunt brothers? Silver hit $49 in 1980. Adjusted for inflation, that's $170 in today's dollars, and we're currently at $92. But the fundamentals suggest we could go even higher than the inflation-adjusted 1980 peak. Consider the gold to silver ratio. Historically, silver has tracked gold at a ratio of around 15 to 1. Some geological estimates suggest silver is naturally found at approximately 17.5 times the abundance of gold in the Earth's crust. Recent market data shows the ratio has been dramatically wider in recent decades. Gold is currently trading around $4,300 per ounce. If silver were to return to even a 30 to 1 ratio, that would imply approximately $140 per ounce. At a historical 15 to 1 ratio, we're looking at nearly $287 per ounce. I'm not saying that's guaranteed tomorrow, but I am saying this. We don't need conspiracy theories. We just need what economists call mean reversion. And mean reversion, historically, tends to happen eventually. The question is timing. Here's my thinking on catalysts. The structural deficit is real. According to various industry reports, we've been consuming more silver than we mine for multiple consecutive years. The Silver Institute confirms ongoing deficits. Meanwhile, industrial demand keeps rising. Solar installations are accelerating globally. Electric vehicle production is ramping up. 5G infrastructure continues expanding. Every major technological trend of this decade increases silver consumption. On the supply side, there's no relief coming. Mining production takes 7 to 10 years from discovery to first production. There are no major new silver deposits in development that could meaningfully impact supply in the next 24 months. Base metal prices, from which 70% of silver is produced as a byproduct, have been volatile, discouraging new mining investment. What happens when industrial users, who absolutely need silver for manufacturing, compete with investors who want silver as monetary protection for a finite supply that's shrinking? That's the scenario that keeps me analyzing these markets. Now, let me address something critical. Silver dropped from its recent highs near $92 to wherever it trades today. Some people might say, see, the rally is over. But that's not how I read the pattern. Every major bull market includes corrections. Gold corrected multiple times on its way from $720 to $1,923 between 2008 and 2011. The question isn't whether there are pullbacks. The question is whether the fundamental drivers remain intact. And in my analysis, they do. The supply deficit hasn't changed. Industrial demand hasn't changed. The expansion of money supply hasn't changed. Central banks globally are still dealing with massive debt burdens and inflation pressures. These aren't temporary factors. These are structural issues that take years, sometimes decades, to resolve. Here's what I think people miss. This isn't just about silver. Silver is the symptom. The dollar is the underlying issue. Since 1971, when Nixon closed the gold window, the dollar has been pure fiat currency, backed by confidence and economic strength, but not by physical assets. After over 50 years of continuous deficit spending, after multiple rounds of quantitative easing, after expanding the money supply by trillions, some economists argue we're witnessing the long-term consequences. Gold is above $40,200. Silver recently hit $92. Both metals are sending the same signal. Paper currencies face long-term pressure. Scarcity matters. In my analysis, silver might still be undervalued relative to gold, undervalued relative to its industrial importance, and undervalued relative to money supply growth. When the market corrects that undervaluation, if it does, the move could be significant. In 1980, silver peaked at $49. It took 45 years to break that record decisively. 45 years of what some observers call suppression through paper markets. 45 years of accumulation by those who understood the pattern. 45 years of coiling. And now we're here, trading above $90, having already doubled in the past year. The Hunt brothers were early. They got crushed because they used excessive leverage and because the system changed rules against them. But they were fundamentally correct about the monetary crisis and silver's response to it. The difference now? This isn't two reckless billionaires fighting the system. This is global market forces, industrial demand that cannot be stopped, investment demand responding to monetary concerns, and supply constraints that cannot be quickly resolved. The signals are everywhere. Record prices, structural deficits, elevated premiums on physical metal, ongoing geopolitical tensions affecting currency confidence. That's not coincidence, that's convergence. Stage 1, the setup, complete. Stage 2, expansion and debasement, complete. Stage 3, recognition of crisis, happening now. Stage 4, the full adjustment, potentially loading. You don't have to believe me. But you should study history, and history shows that fiat currencies eventually face reckoning moments. I'm not a financial advisor. I'm someone who's been studying these patterns, watching these markets, trying to understand what's unfolding. The silver situation isn't coming anymore. It's already here. We're already up 150% in 1 year. The only question is whether this is the beginning of a larger move toward that inflation-adjusted 170 level, or whether the paper market can somehow suppress prices again. The choice is yours to research further. But think carefully, because the pattern is clear, the fundamentals are documented, and the historical precedent is undeniable. If you want to follow along as this unfolds, if you want to understand the deeper mechanisms behind commodity cycles and monetary history, I'll be tracking developments and sharing analysis. Do you think silver reaches $170 in the next 12 to 24 months? Drop your thoughts below. This might be one of the most important financial stories of 2026.